Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation.
I'm Jamie.
And I'm Alex. Midweek special in AI, yes, another one. But whilst everyone writes think pieces, there's been a fundamental restructuring determining whether UK banks remain sovereign businesses or become glorified tenants.
That's really the mission today, isn't it? We're looking at this moment not just as a tech shift, but as what our source material calls a polycrisis.
A polycrisis.
Yeah, it's this perfect storm of generative AI, the fracturing of global regulation, and what we have to call cloud capital. And it forces a complete reevaluation of, well, everything. Where value is created, who captures it.
So our goal today is simple: to cut through the hype and ask if UK banks, these pillars of stability, are actually defaulting into becoming, as you said, glorified tenants, just paying rent to big tech.
And are they holding all of the regulatory liability, but none of the actual control? That's what we need to unpack.
Okay, let's start with the economics, because there's a huge disconnect at the heart of this AI build-out.
There is. It's what Sequoia Capital calls the revenue gap. And it really is the $600 billion question.
$600 billion.
$600 billion
Yeah.
annually. That's the revenue the AI industry needs just to break even on the cost of the GPUs, the data centers, all the infrastructure.
And the reality is they're nowhere near that number, are they?
Not even close.
Mm-hmm.
The gap is widening. And it's currently being plugged by, venture capital and the massive balance sheets of the hyperscalers. Microsoft, Google, Amazon. They're basically underwriting the cost of intelligence right now.
You see this in the operational numbers. I mean, OpenAI is reportedly spending something like $700,000 a day
Daily.
just to run ChatGPT, with a very, very uncertain payback.
And that's where the skepticism from the street comes in.
Yeah.
You have Goldman Sachs asking, too much spend, too little benefit.
It's not just sentiment either. There's hard academic data.
Absolutely. Duran Asimoglu at MIT, he projects that only about a quarter of the tasks exposed to AI will actually be cost-effective to automate in the next decade.
Which gives you, what, a tiny productivity boost.
A cumulative boost of maybe 0.5% to GDP,
Yeah.
which is, it's not nothing. But it in no way justifies the trillion-dollar investment we're seeing.
So here's the challenge then. We're building dependencies, core business functions, on vendors that, frankly, might not survive a market correction.
Or they'll just hike their prices. Suddenly, that API access costs 400% more overnight because they have to start turning a profit.
What happens then if your entire credit risk model is built on their proprietary tech?
Well, that's the vendor risk, isn't it?
Yeah.
But there is a counter-narrative. I mean, we have to be fair.
The fiber optic parallel.
Exactly. The late 90s boom, we saw massive overinvestment in laying cables across the Atlantic. A lot of companies went bust.
But we were left with a huge reservoir of cheap bandwidth that fueled the next 20 years of the internet.
Precisely. The argument is that this year the data center is the same thing. Overinvestment today creates a future reservoir of compute that will eventually drive the marginal cost of intelligence down to almost zero. It becomes a cheap utility.
Okay, I see the parallel. But that doesn't solve the immediate problem for a banks board today, does it?
No, it doesn't. So for you listening now, this is acute vendor risk. The PRA hasn't explicitly mandated specific AI exit strategies yet.
But it's coming.
It is absolutely coming. You need a plan. You need vendor exit strategies. You need to be looking at open source models as a credible off-ramp to avoid that lock-in.
So from the brutal macroeconomics to the micro-reality inside the banks, let's talk productivity. The poster child here is Klarna.
Klarna's numbers they're not projections. They're hard actuals.
Yeah.
And they're staggering. Their AI assistant handled 2.3 million customer service conversations.
In 1 month.
In 1 month. That is the equivalent workload of 700 full-time human agents.
And it wasn't just volume. Resolution times dropped from 11 minutes to under 2.
The financial impact is a 40% cost reduction per transaction, a 152% increase in revenue per employee. These are the numbers getting boards very excited.
And we're seeing this across the UK. NatWest, Standard Chartered, they're all reporting real, tangible productivity gains.
The gains are real. But this is where we hit the productivity paradox. And it's a critical new risk.
The idea that AI doesn't create a leisure dividend?
Far from it. The NBER, the National Bureau of Economic Research, found that AI adoption is actually associated with longer work hours.
Because it makes each human hour more valuable to the firm.
It's workflow intensification. Think of a compliance officer. They used to review 10 complex files a day. That was their capacity.
Now with AI doing the triage, summarizing, flagging the risks.
They're expected to review 50. The human is still the final checkpoint, the final sign-off, but their workload is multiplied. That's not efficiency in the traditional sense.
Hmm.
It's augmentation, but it's also intensification.
And that introduces two huge new risks. First, operational resilience.
Exactly. Your staff are augmented to 150% of their old capacity. They're prone to burnout, to cognitive overload. You're introducing brittleness into the human part of your system.
Which boards haven't priced into their impact tolerances, have they? They plan for an IT outage, but not for collective staff burnout because the system is running too hot.
They haven't. And the second risk is conduct, the consumer duty angle.
Right. If you use that AI to turbocharge your sales staff so they're cross-selling at 3 times the previous rate.
Is that delivering fair value? Or is it just productivity-driven mis-selling at an unprecedented scale? You have to be able to prove you're avoiding that foreseeable harm.
So the cost savings are seductive, but they mask this deeper threat, this human brittleness.
Boards have to ask, what is the impact tolerance for human fatigue caused by AI? And are we auditing for it? If you're finding this useful, follow RegTalk UK on Spotify or subscribe on YouTube.
Right, Alex? Regulatory fracture.
Let's get into it, because the tech might be global, but the rules are anything but. We're seeing this great regulatory fracture.
You have 3 distinct models emerging. The UK has bet on strategic ambiguity.
The pro-innovation, flexible, principles-based approach, no specific AI legislation for now. Right. They're relying on existing regulators, like the FCA and the PRA. And for retail banking, the Consumer Duty has become the de facto AI regulator.
Which sounds lenient, but you've said before it can be draconian in practice.
Because of the word foreseeable.
Mm.
If an LLM hallucinates or shows bias in credit scoring, the FCA will argue that harm was foreseeable. Because we all know these models have those limitations. The black box defense is dead on arrival.
So you can't just blame the vendor. The liability sits with the bank, with the senior manager.
Absolutely. Now contrast that with the EU Fortress, the EU AI Act.
Rigid, risk-based, mandatory conformity.
Totally. If you're using AI for something like credit scoring, it's automatically classified as high risk. That triggers mandatory conformity assessments before you can deploy it.
Which is a huge compliance burden.
It's massive. And here's the crucial part, the Brussels effect.
The idea that EU rules become the global standard.
Because the Act applies extraterritorially. If your UK bank serves a single client in Paris, your systems affecting that client have to comply. So what do global banks do? They just default to the stricter EU standard across the entire group to simplify things.
Which completely nullifies the UK's supposed deregulatory advantage, doesn't it? The UK's flexibility. Is it an advantage or just dangerous ambiguity?
I think it's the latter. Because if you're serving EU customers, you're doing EU compliance anyway. So where's the deregulatory win? It's a strategic headache.
And then you have the Asian models. China's very different again.
Completely state-centric. New regulations there mandate that any AI content has to reflect socialist core values. Finance AI is watched like a hawk for social stability risks.
Versus Singapore's approach.
Which is more collaborative.
Yeah.
Soft law. They use the FE principles, fairness, ethics, accountability, transparency, and give banks practical toolkits like Project Veritas to test their models.
So the bottom line for a UK bank is that navigating this divergence is the primary compliance challenge.
It is. You almost have to ignore the UK's flexibility and just prepare for the EU's rigidity, because that's the standard that will travel.
This dependency, this regulatory mess, it leads to the most provocative idea in our research. Techno-feudalism.
This is the Varoufakis thesis, and it's a powerful one. He argues we've moved beyond capitalism to something new.
Not a market-based system anymore.
No. A system where big tech, the cloudlists, he calls them, AWS, Azure, Google act as feudal lords. They own the digital land, the cloud, and everyone else just pays rent to operate on it.
And banks are the vassals in this model.
The ultimate vassals. They hold the regulatory license and all the liability, but their operational reality, their core ledgers, their payments, their AI compute is totally dependent on big tech's infrastructure.
Varoufakis has that great quote about Bezos. He doesn't care what you buy.
He simply controls the digital system, collecting a ground rent. It's not about selling a product. It's about owning the platform where all transactions happen.
So when a bank uses GPT-5 for a credit decision, it's essentially paying a tax on its own thinking process to Microsoft.
That's the cloud rent. A tax on cognition. Now, there's a pushback, isn't there?
Of course. The argument that this isn't some new feudalism, it's just monopoly capitalism on steroids.
Right. Evgeny Morozov and others would say it's just hyper-capitalism. Rent-seeking has always existed. Standard Oil did it.
But call it what you want. Techno-feudalism, hypercapitalism, the strategic implication for banks is identical, isn't it?
It is identical. The balance of power has definitively shifted from the owners of capital, the banks, to the owners of the network, big tech.
Which means the only rational response is a defensive one. You have to build your own sovereign infrastructure.
You have to. Which brings us directly to the RLN counteroffensive.
The regulated liability network. This is the industry's answer.
It has to be. Because by 2026, we're going to be dealing with agentic AI.
Autonomous software agents making financial decisions.
Exactly. An AI agent trying to optimize cash balances or negotiate insurance for you, they need programmable money to work.
And our current payment rails, BACS, JAPILs, they're dumb pipes. They can't handle that kind of conditional logic.
They can't. So if the banks don't provide a solution, what happens? The economy migrates to stablecoins, to USDC. The agents will just use what works.
Which leads to the disintermediation of the entire banking deposit base, an existential risk.
It is the existential risk. And that's why the RLN is so critical. It's a shared ledger for central bank money, commercial bank deposits, and e-money.
So it gives you the benefits of tokenization, the programmability, the 24/7 settlement.
But it keeps it all within the regulated system. It preserves the singleness of money. A digital pound at Barclays is the same as one at Monzo.
And this is happening globally, too, with Project Agora.
Yes, that's the BIS, 7 central banks, including the Bank of England and the Fed, plus 40 private firms. It's a unified ledger for wholesale cross-border payments.
To solve those huge inefficiencies.
And to allow for atomic payment versus payment settlement. It's transformative. So this isn't some optional innovation project for banks.
You're saying this is defensive infrastructure. Banks are building a moat around commercial bank money.
They have to. Without it, AI agents will just use big tech stablecoins, and that accelerates the whole techno-feudal shift. Participation isn't optional, it's existential.
But to build any of this, you need people.
Yeah.
And this is where the next crisis is, the talent catastrophe.
It's a perfect storm, really. First, you have the university meltdown. The warnings to Parliament are stark. Up to 50 higher education providers in England are at risk of insolvency in the next couple of years.
50? That's a huge chunk of the graduate supply chain just disappearing.
It shrinks the talent pool and drives up wage inflation for the few graduates from elite universities. But the second problem is arguably worse.
The degree itself is becoming worthless as a signal.
Completely. We've seen data that 92% of students are using AI in their assessments.
So that 2.1 you're looking at on a CV, it tells you nothing about their actual critical thinking or writing skills. AI has commoditized it.
There's a total trust deficit. And this intersects with the leadership gap inside the banks.
The disconnect between the juniors who use the tech and the seniors who are meant to govern it.
It's a chasm. 83% of young professionals use AI weekly. Only 47% of senior leaders feel comfortable with it.
Which is terrifying. The person signing off under the SMCR responsible for foreseeable harm might be the least digitally literate person in the room.
How can you govern a risk you don't fundamentally understand?
So the only answer for banks is to stop relying on the external system. They have to internalize education.
100%. We're going to see a return of the corporate university model. Banks will have to hire school leavers and train them from the ground up on their proprietary tools, on data ethics, on financial compliance for an AI world.
Okay, we've covered the economics, the risks, the regulation, the power shift. Let's land this with the governance agenda. What are the questions boards need to be asking right now?
This has to be a rapid-fire session. Existential questions, not just operational oversight.
First, vendor exit strategy. What's the plan if our main AI provider quadruples their prices?
And is there a tested plan to migrate to an open-source model as a backup, not just a clause in a contract?
Second, SMCR liability. An autonomous agent loses £50 million. Who, specifically, is the senior manager on the hook?
You have to name the human accountable for algorithm behavior. If you can't, the liability defaults to the CEO.
Third, continuous monitoring. How do we know our models still comply with consumer duty when they're updated daily by the vendor?
You need to move from static policy to continuous monitoring frameworks.
Yeah.
Real-time dashboards tracking bias, false positives, customer outcomes.
Fourth, flip the coin. What opportunities are we missing by not using AI?
Are we passively accepting competitive erosion because a fintech can approve a mortgage in minutes and we still take weeks?
Which leads to number 5, competitive erosion. Could an AI-native competitor, a big tech firm, simply erode our core deposit base?
What's the plan for when agentic commerce takes 15% of your deposit base and moves it to stablecoins?
And finally, a really practical one for the here and now, workforce resilience. What training are we giving staff to work alongside AI safely without burnout?
The investment in people has to match the investment in tech. It's non-negotiable.
So let's pull it all together. The technology is ready, but it's brutally expensive. The regulation is forming, but it's fragmented. The economics are defined by that massive disconnect.
The only variable left is strategic will. The choices made now, in 2025 and 2026, on vendor dependency and infrastructure like the RLN, they determine everything. Sovereignty or just rent paying.
It leaves one final thought. The bank of the future isn't a place that stores money. It's a place that verifies truth in an automated economy. It has to pivot from being a payment processor to a trust anchor.
That's all from us. Thanks for listening to Reg Talk UK.
Until next time, stay sharp and stay compliant.